If someone told you that with one single ETF and exactly 10 years, you could build a portfolio generating over $3,000 a month in passive dividend income, you'd probably think they were exaggerating. But when you sit down and run the actual numbers, using real historical data, not some fantasy spreadsheet, the math is almost uncomfortable because it works. And it works with an ETF you already know. Today I'm going to show you the exact 10-year calculator for SCHD, the Schwab U.S. Dividend Equity ETF. We're going to run 3 different scenarios, including one where you start with absolutely nothing. We'll look at what happens when you invest $5,000 a month, what changes when you start with a $100,000 head start, and then the scenario that might genuinely change your retirement timeline. The one that shows you the exact portfolio size needed to generate $5,000 a month in pure passive dividends. Quick disclaimer: I'm not a financial advisor and this isn't financial advice. Past performance does not guarantee future results. Always do your own research before making any investment decisions. Now let me show you why SCHD specifically is the ETF we're running this calculator with. Not because it's the only good option, there are plenty, but because the combination of current yield and dividend growth rate creates a mathematical effect that gets dramatically more powerful the longer you hold it. SCHD currently sits at around $31 per share. The trailing 12-month dividend yield is 3.38%. The expense ratio is a microscopic 0.06%, meaning for every $10,000 invested, you're paying just $6 a year in fees. That's cheaper than a single lunch. The fund manages over $85 billion in total assets, making it one of the largest and most liquid dividend ETFs in existence. It holds 102 companies. Names like Lockheed Martin, ConocoPhillips, Verizon, Chevron, and Bristol-Myers Squibb. These aren't speculative growth plays hoping to become profitable someday. These are massive, established cash flow generating companies that have been paying and consistently growing their dividends for years. But here's the number that makes the 10-year calculator so powerful. SCHD's 5-year dividend growth rate is 9.15% annually. That means the dividends you receive today are 9% larger than what you received last year. And next year's will be 9% larger than today's. When you stack that kind of growth on top of reinvested dividends over a full decade, something remarkable happens to your yield on cost. Let me show you exactly what I mean. Let's start with scenario A, the one most people think is impossible. Harry starts with absolutely nothing, $0. But he commits to investing $5,000 per month into SCHD and reinvesting every single dividend. No exceptions, no skipping months. $5,000 every month for 10 straight years. Now, $5,000 a month is aggressive. That's $60,000 a year. Not everyone can do that. But stay with me, because the math reveals something important regardless of your number. Harry's total out-of-pocket investment over 10 years, $600,000. That's the money that actually leaves his bank account. But using SCHD's historical 5-year average total return of 12.5% annually, which includes both price appreciation and reinvested dividends, Harry's portfolio could potentially grow to approximately $1,140,000. Let me say that again. Harry put in $600,000. The portfolio grew to roughly $1.14 million. That means over $540,000 was generated by the investment itself, not by Harry's contributions. Growth and reinvested dividends did more than half the work. And here's where the dividend income gets real. At a 3.4% yield on that $1.14 million portfolio, Harry could be generating approximately $38,783 per year in dividends. That's about $3,231 per month in passive income from one ETF. But I know what you're thinking. $5,000 a month is a lot. What if you can't start that aggressively? What if you have some savings already but a smaller monthly contribution? That's where scenario B comes in. And honestly, this one might be even more interesting. Harry already has $100,000 invested. Maybe it's from years of casual saving, a 401k rollover, or an inheritance. He adds $2,500 per month to SCHD and reinvests all dividends. 10 years later. Using the same 12.5% historical return, Harry's portfolio could potentially reach approximately $895,400. His total out-of-pocket after the initial $100,000 was just $300,000, but the portfolio nearly tripled his investment. At a 3.4% yield, that $895,000 portfolio could generate about $30,443 per year, or roughly $2,536 per month in dividends. Now, I want to point out something crucial about the difference between these two scenarios. Harry B put in $400,000 total, $100,000 starting plus $300,000 in contributions. Harry A put in $600,000. That's $200,000 more out of pocket. But Harry A's portfolio ended up larger. Why? Because Harry A had more money invested earlier, which meant more dividends being reinvested earlier, which meant more shares generating dividends sooner. That's the snowball at work. Time in the market with reinvested dividends isn't just a nice concept, it's the mathematical engine behind this entire calculator. Now let's pause here, because this is the part most SCHD videos miss entirely. They show you the end number and stop. But the real magic isn't the final balance. It's what happens in the back half of the 10 years. And understanding this is the difference between quitting at year 3 and building generational wealth. See, SCHD's dividend growth rate of 9.15% means your yield on cost changes dramatically over time. In year 1, your 3.4% yield means every $10,000 invested generates about $340 in annual dividends. But by year 5, that same $10,000 investment, because the dividends have grown at 9% per year, is now generating roughly $523? And by year 10, that original $10,000 is potentially generating over $809 in annual dividends. Your yield on cost could effectively more than double over the decade. The first 5 years feel slow. The last 5 years feel like a completely different investment. That's not speculation. That's math applied to SCHD's actual historical dividend growth rate. This is why most people give up on dividend investing too early. They see the first 2 or 3 years and think, $340 a year in dividends? That's nothing. That won't even cover a car payment. And they're right. In year 1, it's modest, but they're looking at the wrong year. The dividend snowball doesn't whisper in year 1 and 2. It screams in year 8, 9, and 10. If you can sit through the quiet years, the loud years are waiting. And this brings us to scenario C, the one that answers the question everyone's actually thinking. What if Harry wants exactly $5,000 per month in passive dividends? $60,000 per year. What does that portfolio need to look like? At a 3.4% current yield, generating $60,000 in annual dividends requires a portfolio of approximately $1.76 million. That's the target number. $1.76 million. Now, if Harry already has that $100,000 and the market continues delivering around 12.5% total returns, he wouldn't need to add another dollar if he was willing to wait approximately 16 years. Just let the reinvested dividends and growth do their thing. 16 years of patience, no monthly contributions, just the original $100,000 growing on its own. But Harry doesn't want to wait 16 years. He's 42. 16 years puts him at 58, close to traditional retirement age. He wants the option sooner, so here's the hybrid approach. And this is where the calculator gets really exciting. Start with $100,000. Contribute $3,500 per month. At 12.5% annual returns with full dividend reinvestment, Harry could potentially reach $1.76 million in approximately 12 years. That's 4 years faster than doing nothing, just by adding $3,500 monthly. And at age 54 instead of 58, those extra 4 years of freedom aren't just numbers on a spreadsheet. That's 4 years of choosing whether to work. 4 years of waking up on a Monday and deciding based on want, not need. And once he's there, $5,000 per month, every single month, without selling a single share. The portfolio stays intact, the dividends keep growing, and Harry's working because he wants to, not because he has to. There's one more thing I want you to understand about SCHD specifically, because the timing is actually significant. SCHD's annual reconstitution, where the fund rebalances its holdings, is happening in March 2026. The expected changes are substantial. Energy sector exposure, which currently sits at around 21.7%, is projected to drop to roughly 12%. Companies like Halliburton and Valero could be removed. Meanwhile, the fund is expected to add more financials, potentially Blackstone, and increase its defensive consumer staples positions. What does this mean for the calculator? It means SCHD is actively managing concentration risk without you having to do anything. The fund is built to evolve. Your 10-year calculator doesn't need manual adjustments because the ETF is adjusting itself, dropping companies that no longer meet its quality and dividend criteria and replacing them with ones that do. That's the part about SCHD that often gets lost in the dividend yield conversation. Yes, the yield matters. Yes, the growth rate matters. But the fact that this fund automatically removes weak dividend stocks and replaces them with stronger ones every single year, that's what makes the 10-year math actually reliable. You're not just betting on today's companies, you're betting on a system that continuously upgrades itself. Let me also address something I know some of you are thinking. 12.5% annual returns seems high. And you're right to be cautious. That's SCHD's 5-year average, which includes a strong bull market. If we use a more conservative 8% total return, the numbers are smaller. But the structure still works. Harry A's portfolio would grow to roughly $910,000 instead of $1.14 million. The dividends would be lower. But the principle, yield on cost acceleration in the back half, reinvestment doing the heavy lifting, the snowball building momentum. All of that holds true at any reasonable return assumption. The calculator doesn't need a perfect market. It needs time and consistency. So let me bring this full circle. Whether you're starting from zero, starting with a head start, or somewhere in between, the 10-year SCHD calculator shows the same fundamental truth. The combination of a 3.4% yield, a 9% plus dividend growth rate, and consistent reinvestment creates a financial snowball that does most of its work in the second half of the decade. The first 5 years build the foundation. The last 5 years build the income. And if you're patient enough to sit through the boring part, the math on the other side could potentially change your entire financial future. Harry's sitting at his desk right now, running these same numbers. He started Scenario B about 14 months ago. $100,000 starting balance, adding $2,500 a month. He's not at the finish line yet, he's in the quiet years. But every quarter when that dividend payment hits and it's bigger than the last one, he sees the acceleration beginning. He called me yesterday and said something I think about a lot. He said, "I always thought replacing my salary would take 30 years and a miracle. Turns out it might take 10 years in a spreadsheet." If you want to see how SCHD stacks up against other top dividend ETFs in a head-to-head comparison, that video is right here. And if this changed how you think about dividend investing and passive income streams, let me know in the comments which scenario fits your situation.